Hi, everyone. This is Jason Burak of Wall Street for Main Street, and welcome to your Wall Street for Main Street podcast. For today, Thursday, for a little while longer anyway, March 31st, 2011. Today, we are joined by Aaron Basile. He's a fusion analyst. He specializes in combining his great technical analysis and fundamental analysis, and he's a financial writer and blogger. And we're just really happy to have him on here back. How are you doing tonight, Aaron?
Really good, Jason. How are you?
Very good. Very good. My Dodgers won tonight on opening day. We beat the world champion Giants, so I'm very happy. And, the Lakers are winning too, so it's a pretty good night so far, except for the weather here in D.C.
The Phillies have a pretty good pitching rotation this year, though.
Yeah, I honestly think the Phillies will win the World Series. Their pitching is just too good. I mean, they could go out and get another bat. But
Yeah.
let's move on. I love sports, Aaron. I'm sure you do too. Let's move on to some financial stuff. There's been a lot, going on in the energy markets. We still have the stuff that's going on in Japan. I think now the reactors are like core meltdown, and the last I heard a few hours ago was they were just going to, bury the whole thing in concrete, thousands of pounds of concrete. What is your opinion of this situation, and how do you think like an investor or trader would be able to potentially profit off this, in the different types of energy markets?
Well, last time we talked about regarding uranium. For patient long-term investors, it might be a good idea to open half a position or a smaller position than you normally would, and go from there and watch what happens. If it bounces, you advance your stop loss. If it falls, your stop loss gets hit, and then you wait for it to give you a clearer bottom. But I think that uranium can go lower here, and that's just the market being the market, really. I know there's a lot of good reasons for uranium to be higher right now. I personally think that the fundamentals are there, especially with the rising oil prices, and now as a result of this, the rising nat gas and rising oil prices, or coal prices. But I do think that ultimately uranium is a great long-term play. A mutual friend of ours, Kevin Kerr, the other day was saying that uranium will come back. Also, I read yesterday that Jim Rogers said that uranium is going to come back when oil hits $150, $200 a barrel, and you're paying $5 of gasoline at the pump. I mean, it just makes sense, and I think that you can get a good long-term opportunity here in uranium, but that doesn't mean that it can't go lower in the next couple of months or even the next year or so.
Yeah, I think those are some good points, Aaron, that people, long term, the fundamentals I think are still there for better, technology advances, better nuclear power plants for the new generation stuff, the thorium stuff, the stuff that IBC Advanced Alloys is working on with the beryllium oxide reactors there to help cool down the uranium reactors a lot faster. So I just think that, these plants were too old, and these guys, like the guy from IBC, he was doing a presentation last week at an investor conference. I was watching it last night, and the CEO of IBC was talking about now his phone's ringing off the hook. Well, look what it took, for people to invest, to think about investing in new technology. And it's really sad that people, aren't willing to, think of this stuff in advance.
Yeah, and it's almost like we're waiting for an authority figure to say that it's okay. But and I really wish we wouldn't do that, because the authority figures are usually the ones that subsidize the wrong things. But
like corn ethanol.
Yeah, exactly. Another thing we covered last time. But if you look at China, for example, I mean, they're investing in rare earths, they're investing in thorium, and even uranium, and all other sorts of base metals. So I don't know why the rest of the world can't get with the program here. I mean, some European countries are functioning very well from nuclear power, and it doesn't make sense to have one really unfortunate situation ruin it for everyone else, especially when, like you just said, those reactors were old and they shouldn't have been used. They should have been retired a long time ago.
But unfortunately, Aaron, like these governments, these central planning, these large interventionist governments, where are they spending the money? I mean, they have a lot of money. They spend it on other stupid stuff, like other pork projects, or they put it in bad investments. Why aren't they replacing, the water pipes? There's natural gas pipes, I think, here in the United States that exploded in Minnesota like 2 or 3 weeks ago, killed a lot of people. The infrastructure, that stuff is the stuff that should have had investments. Where was all the money spent? It seems to me, the money is just the politicians and the lobbyists and stuff are combining, and the business as usual crowd in DC is putting the money, misallocating it to all the wrong places. These nuclear power plants, we have bad ones, or you can make a good argument there's even worse ones in California, where the pools, the reactor pools where the old spent reactors cool down, they're exposed to air too. They're on a couple fault lines. I was listening to debates about this, all week from other nuclear experts. Well, why, there's reports on these from agencies that these plants need to be replaced, and they've been for 10 years that people have known at least that the design capacity need to be replaced. Why has anything been done?
Yeah, that's a good question. And you look at where we're spending our money, though. I mean, you could argue that we have a capital problem because we really have no capital. We have to borrow. But where are we using the capital that we borrow? Well, we're using it for social programs. We're not using it, for energy where we really need it. And both of us don't believe in the government subsidizing anything. But if you're going to subsidize something, at least do it right, and at least uh, make your subsidies beneficial to the general populace, and not just let natural gas lines explode and not do anything about them. It doesn't make any sense.
Yeah, I completely agree, Aaron. And then you have people talking about stopping the Restart Act and going after China for stopping the rare earths quota exports. You have China hiking taxes on rare earths again. So if we are going to transition, and the people at Congress here in the United States and in Western Europe are talking, oh, okay, well, we'll just transition to the alternative energies. But we can't do any of that without rare earths.
Yeah, and well, there's people talking about getting back at China by, like, for example, Donald Trump thinks that we can just put an import tax, 15% or whatever it was, import tax on more, Chinese goods, and act like that's not just going to have extremely large ramifications for us. Because if we do that and the yuan rises, well, what do you think is going to happen to prices in the U.S.?
I think it'll wipe out the middle class, Aaron, just
Right.
as fast, as a dollar crashing would, because the middle class, the people, that are barely getting by. I mean, the poor who are living off, government money, the crime rate would spike. It would be, disastrous too. It would have a very similar effect to the dollar actually crashing, if China actually revalued their RMB, or, Bernanke, or people stop taking dollars. We're talking about a lot of macro here. It's not something, you and me really want to be talking a lot about. We'd rather, be focusing, looking at companies and stuff. But unfortunately, this is the environment that we're in.
Yeah, absolutely. Um, and well, we've talked about companies before that can profit off of this stuff, and I mean, for example, just the rare earth companies. If you've looked at Molycorp's chart any time in the last couple of weeks, you'll notice that they've had a absolute robust breakout of a few resistance points on the chart, and that was after Chinese said that they were going to become a net importer of rare earths and that they were going to cut export quotas again. Molycorp has some resistance at about $62.50. So they're close to that now. But, I think they could top out there before retesting that. But, I mean, Molycorp, again, was just the other day in talks with policymakers in Washington. Another tiny rare earths company, Ucore, a company that we both follow, was in talks with policymakers in Washington a couple months ago. And you're starting to see the Congress in the U.S. at least start to pay attention to rare earths and understand the magnitude of what's going on. And there are ways to profit off of this. And you and I both have talked about rare earth juniors like Ucore, Great Western Minerals, Stan's Energy, Avalon, and the list goes on, really.
Yeah, and Linus is also, in production right now. They're not processing the oxides yet. They're just, mining the stuff and they're stockpiling. And they're going to start, processing, I think, in September this year. So that'll be interesting to see, how smoothly that goes. So you think there's still value here in the rare earths, or do you think this is more of a momentum trade, here in the short term?
In the short term, I actually covered this a few days ago on my website. It looks like a lot of these rare earth stocks, including Molycorp, Great Western, Linus, Stans, a lot of them are getting close to a double or even a triple top in their own respective share prices. And I think that based on the length of the consolidation that's happened since the beginning of the year, and based on the news that has happened and come down the wire since then, I think that they'll retest those highs. They might not break it the first time. I think they'll have a little bit of a pullback, but I think that pretty soon we will see the next leg in the rare earths bull market. Um, and I know that there's a lot of people out there who aren't sold, and I can understand that the valuations don't add up to some degree, and a lot of people think that it's just a very volatile and risky market to trade. But if you use a prudent stop loss and you're smart about how you enter your positions with these companies, you can make a lot of money. There's a lot of upside here. I mean, the upside is just enormous. And if you use a reasonable stop loss, you can, save yourself a lot of risk and, take a lot of that, the downside risk out of the trade.
Those are some good insights, Aaron. Also, maybe people should look at, learning options as, maybe a long straddle option like a Molycorp, because the stock, could continue to be volatile where it might be smart, when the stock's rising, like high like it is now, maybe to buy out of the money puts, and then on a pullback, buy out of the money calls. Or they could, buy a long straddle at a certain price. But, options are a tool and they're very, dangerous if you don't know how to use options. I've heard a lot of horror stories from a lot of people, like, first few times I trade options, they weren't, successful. So, someone needs to have the education in place to trade them. But, we have Mo and a few other people I know, who do very well with options.
Yeah, absolutely. I mean, all of us in the Wall Street from Main Street community would be happy to help out anybody that wants to know about options or anything related to finance, really. But out of the money calls are one of my favorite ways to invest. It just reduces the volatility that you see between monthly periods, and if you buy like leap out of the call or out of the money calls, a year or two in advance, they can just be really profitable. You can sell at a year-to-date peak and then buy at a year-to-date low and really maximize your profits that way.
Yeah, that's exactly right. And plus, Aaron, they could control like 100 shares of Molycorp stock for only like 800, $600 to $800. They can control one contract, which is equal to 100 shares. So you don't need to have all that capital. You can, benefit. Now, like it's, you're risking you can lose all your money if you're wrong, but if you give yourself some time to let it play out, you could do very, very well. I've definitely seen the results, from people who have learned options. And the key is just educating yourself and, not buying. It's like with the stock thing, it's not, buying all your position all at once. It's like, if you're going to spend money to buy, 5 Molycorp calls, don't buy all 5 at once. Buy like, one or two, this week. And then, like keep the money like there and maybe wait for a pullback and dollar cost average in if you're going to buy those Molycorp leaps, like you said, because I think in 3 years, whereas some of these other rare earth companies, and I think there's really only 15, maybe 20, at most, 25, who could maybe even get bought out here. I would put the line very discriminately. I don't think there's going to be more than, 20, 25 total who get consolidated in this whole sector. There's only going to be 10 or 15 in production in 5 to 7 years at most. And, the fundamental stories are not all the same. Like you look at Quest, like Quest is going to be a lower cost producer, but they're not going into production until 2016. Avalon has a super high capex of like when you add in all the railroads and all the stuff out to their property, which is in the middle of nowhere, it's going to be a couple $1 billion, and they're not going to be in production until 2016, and then their deposit's only like 20% heavies. So yes, the asset's good, but you got to look. It's the fundamentals are not the same as Molycorp. Molycorp has a humongous advantage. Molycorp is going to be hitting the cash flows in 2 or 3 years, like big cash flows.
Yeah, most of the bigger name rare earth producers, or future producers, I should say, really aren't that big of companies themselves, and most of them are in countries with geopolitical risk, like Great Western. They're in South Africa. Stan's Energy is in Russia. Uh, you know,
Kyrgyzstan, but the Russian government, I heard, is already like
uh,
Stans is looking at properties in Russia too.
that's right. Uh, but the point is, though, I mean, you're right. There's not going to be. I mean, I was just talking to somebody today who was debating me about the availability of rare earths, and how, he was saying that they'll be plentiful and there's plenty of rare earth deposits around the world, and that's true. But with the sector consolidation that's coming up, these tiny companies are going to be bought out. They're going to consolidate, and there's only going to be 10 or 15 producers. And even with government funding, you can't get one of these deposits online in any less than 5 years. And that's with government funding, and assuming that there's no geopolitical risk, like a country in Africa or something where you could have some fundamentalists and rebels take over the plant and cause a great hostage situation or something. So there's really a lot of value in Molycorp.
Exactly, and I think there's also value in Linus. Like Molycorp, if Linus had production problems, for a year or two, Molycorp cash flows because everything's set up nicer for Molycorp. There's they've already tested the ore body out. They have more experience processing it, separating it with the chemistry and stuff, and the metallurgy. Molycorp could end up buying Linus, buying Great Western Minerals. Molycorp could own the whole industry if it wanted to. Well, most of the industry if it wanted to, if it timed things perfectly. You could see where Molycorp basically just consolidated the whole industry. So the people who are bashing the whole industry, I don't think they get the whole industry.
No,
And,
Molycorp could be an Exxon Mobil if they do this right, and if everything plays out right. That's probably the potential upside. I know that there's a lot of downside, but I mean, the upside is just unbelievable
yeah,
for these rare earths.
Yeah, exactly, Aaron. So maybe people then, buy, if they go long Molycorp, and then maybe buy some insurance, some put protection on their shares. That would be, an option for people. They pay a little peace of mind then, so they still have their upside and they have some insurance on the downside.
Yeah, or if you're not comfortable using options, just buy it when it's got a confirmed bottom using the charts, let it rise, watch the sector closely, advance your stop loss to every next support level, and if something happens where everything falls apart, then you get stopped out and you make money. It's not, you don't have to go all in and put your entire life savings into this company.
Exactly, Aaron. Exactly, and I think people don't look at things completely rationally sometimes. They get a little too greedy, they get a little too emotional, and they bet it. They go all in. They don't write out like what their investment plan or trading plan is. And I know you're very good at that. You're very rational for a 21-year-old. You just have everything. You can participate in good arguments with me and other experts.
Yeah, I mean, we all, especially, retail investors, we all lose money sometimes, and when we first start out and we think irrationally. But, with the proper education, you can really turn a small amount of money into a lot, and that's what's so great about the Wall Street for Main Street company.
Thank you, Aaron. Thank you for the plug. Moving on a little further. I want to talk about a little bit, different sector of the energy, or we talked about uranium and rare earths a little bit, but it seems to me, that natural gas is just, getting a little bit of a comeback here. I'm looking at the chart of Golar LNG. It's GLNG if you want to pull up the chart real quick, Aaron.
Mm.
And the max chart, the GLNG, the thing is just, it's taken off like a rocket, since the Japan news. The thing has just gone nuts, basically. It's gone, straight up. And I guess that's, the market anticipating, I guess, that Japan is going to be making the transition, away from nuclear power. And we also have that stuff, going on in Libya still, with the light sweet crude and Gaddafi, defying the globalist orders. And, I don't want to get into some of the other conspiracy stuff or why we're there, but, how much money are we wasting now for every missile we fire into there? So.
Well, I can't remember what the actual number is. I I've heard some pretty ridiculous estimates, though. I think it was like something like 70 million per missile.
Yeah, it's at least a couple $100,000, for each Tomahawk or missile or whatever. It's a humongous amount of money, and then I think we're putting some forces in there now. Do we have ground forces in there now, or are they still thinking about that?
I think they have them there, but they're not in combat. You know, while we're on the subject, though, the one thing that I will give Donald Trump credit for is he did say that if he was president, that he would force countries to pay for our protection. Which, I mean, I'm an Austro-libertarian, so I don't advocate any type of military intervention. But as an alternative, if you're going to be there, at least we could get paid for it.
Isn't that protection, a protection scam like what a mob would do? Like,
Well,
like pay for protection in the neighborhood?
well, sure, but at least at least we'd be able to make some money off of it. And if they can't pay, then we leave our troops at home. So
Well, that's good now that we have up front, we have the price tag on the mercenaries.
exactly, exactly.
There was actually a really funny, John Cusack movie about this a couple of years ago. It was called War Inc. with like John Cusack, his sister Joan Cusack. Dan Aykroyd was supposed to be Dick Cheney, and it had Hillary Duff in it. Do you remember that movie?
Yeah, I remember.
Yeah, that was. It's kind of playing out now, Aaron. This is just kind of ridiculous. Okay, well, let's.
I told you nat gas, though. Nat gas would be a play because the government will subsidize that. They will not subsidize coal because the EPA and all the environmentalists, that will be political suicide. And I think natural gas is the play that the government will subsidize. It's not necessarily the best play, but I think that's the one that they will go after. And looking at the continuous contract for the NYMEX, it was at about 380, and now it's at 439. So in just a couple of weeks since the Japan earthquake, it's gone up 25-30%.
Exactly, Aaron. And, that's still not even a big, recovery. Like, we still have a supply glut of natural gas. So people, should not say that, oh, I missed the natural gas move. I still think it's, a good buying opportunity for natural gas for people that are more patient. People need to, say that, oh, okay, well, we're going to be transitioning here to natural gas. And, that it's just cleaner than coal. Well, once it's out of the ground, it's cleaner than coal.
Right.
The fracking is another story, the hydraulic fracturing.
Yeah, absolutely.
That's going on. Yeah, I think the GL and G Goal are like looking at the chart here, and like I wouldn't say it's a good value play here at this point. Like on the max chart, it looks like it's at an all-time high on GLNG. In fact.
Well, I don't know how many people like to play the futures market because that's very dangerous because of all the investment banks running hog wild. But there are other natural gas plays out there, and I mean, if you look at the continuous futures contract, it hasn't even taken out the January high, and we've had an earthquake which literally wiped out anybody who wanted to be long uranium, and we still don't have natural gas hitting high. So I think that maybe not from a valuation for a specific company, but a valuation from the specific commodity is still a very good play.
I'll remind people of one company that will be bringing natural gas on in a few years. They don't have any on right now, and that's BPZ. I really like them as an oil play. They actually, just expanded their P2 oil reserves. They went from only like 33 million barrels of oil reserves couple like last year, and now, at the end of the year, they've been doing more exploration drilling in Peru offshore there, and now it's over 90 million barrels. So, they just expanded the P2 reserves just tremendously. The stock hasn't moved. They're producing oil, so you're getting the oil, at a humongous discount, and then you're getting the natural gas in a couple years for free. So that's one of the ones that I'm looking at. I haven't bought any shares yet to disclose that. Do you have any plays, Aaron, in natural gas or oil where you think people should start doing some research?
I don't have any actually. I do know that oil has run up for a long time though, and if you look at the chart of Chevron, that has just been a rocket, and for a company with a market cap that big, if you're not looking for a valuation but you're looking for a growth play, after this stock pulls back, I would actually recommend Chevron. And I know that's a little bit of a stretch for me because I'm not big into large caps, but I think that's a good growth play. Um, as far as valuation plays, I don't really have anything. You're more well-rounded in the energy sector than I am.
Yeah, sorry to put you on the spot there, Aaron. Yeah, we didn't. This wasn't, something I told you to do any research on beforehand.
But honestly, though, the Chevron, that is for a growth play,
Yeah,
that is a great stock.
yeah, Chevron's going to be bringing on, a lot of natural gas projects. They've been working on a lot of deals. I think they have something offshore in Australia, a humongous natural gas project, and that they've just been diversifying themselves. A lot of the other oil majors have just been moving, transitioning their assets to natural gas instead of oil. So they've, been investing in natural gas around the bottom. They've been spending a lot of money here. You had Exxon that bought out XTO Energy. You had the Chinese, move into the shale with Chesapeake Energy on those deals.
Yeah, Exxon's been moving into alternative energy very slowly for quite a while, and I expect them to do that even more now that, like, alternative energy has dropped significantly. So I think that, their management should look at this as a buying opportunity. I think they will.
Okay, well, maybe, instead of picking out individual companies, Aaron, maybe people take a look at some of those oil energy like indexes, with the producers like an XLE or one of the oil well and services ETFs like that has, Transocean and Diamond Offshore Drilling and some of those other guys in there, Baker Hughes and some of those other plays in there.
Yeah, OIH is another good one. Oil Holders Service Trust, I believe it's called. It generally performs hand in hand with the sector. Most of the ETFs, though, have been pretty robust, a lot more so than uh, the oil drilling companies, the producers, and the refineries, mainly because the commodity is exempt from margins, and when you have the threat of economic contraction like you do with rising oil prices, like a company like Chevron or Exxon or BP, anybody like that, can have their margins hit as demand falls if oil rises too high. And so you can hedge yourself if you buy like an XLE or an OIH, just one of those ETFs, and it's generally won't get hit as hard if the economy starts to slide because you won't have those margins that the companies are going to have to meet.
Those are some good points, Aaron. The energy complex, I think, I think the oil is going to go up higher, for multiple reasons. We have, still the conflicts in Libya, and the U.S., could possibly have to move into Saudi Arabia or other countries. We could have to bring forces in there too. We just don't know yet. And then you have the stuff going on in Japan, how they're bringing in, more oil, natural gas, diesel, coal, perhaps. I think they're bringing in more coal too. And on top of that, you have the devalued dollar. So this is setting up, for a really really bad shock for, consumers, people who need food and energy. As
Right.
as you know, on the CPI, they don't think we need on food and energy apparently.
Yeah, and the thing is oil can continue to rise even as the economy contracts. You'll see the the Hess, the Valero, they'll lose money as they'll hit a ceiling. They might not necessarily lose money, but they'll hit a ceiling somewhere, and oil can still rise if the dollar is continued to if the Fed keeps purchasing treasuries and and just exporting all our dollars to Brazil and China and India. Oil can still rise, especially if those economies, those emerging market economies, don't crash, because they will drive up the price of oil, and the American consumer will get stuck with the bill, even though they're not consuming more oil. They'll just have to do it just to get to work.
Exactly, Aaron. Or they're going to have to carpool, or they're going to have to, stop going to work altogether and maybe, just work from home. And I don't know how many people can do that, but, if you have a sales job, maybe you could, call on the phone, cold call, or do whatever. But, our economy is going to have to adjust to, basically the end of cheap oil. And that's basically what peak oil is all about. It just, it doesn't mean we're running out of oil anytime soon. It just means that, like, all the cheap, easy oil is gone. Especially all the conventional stuff. I mean, look at how people are fighting over, the light sweet crude in Libya, because that stuff's easier to refine. So this is just a potential disaster, here with higher energy prices. If we go over, 140 a barrel again, and you add that in with the other stuff, the possibility of QE3 down the line. And that would be my next question for you, Aaron. You brought up permanent market operations, or POMO as it's called. And, what are your opinions here coming down the line here about a QE2 extension, or the Fed expanding things further on top of that into a QE3?
Well, I I saw a chart actually on Zero Hedge a few weeks ago, and it showed the S&P 500, showed a bunch of other indexes, bonds, other type of equity investments, and it showed that it was a performance chart, and the performance was linked to the size of the Fed's balance sheet. And since I think it was about probably the past year or so, everything has been linked literally hand in hand to the size of the Fed's balance sheet. So what that means is if the Fed's balance sheet shrinks, meaning they stop permanent open market operations in the QE and the 0% interest rate policy, that means everything essentially, well, I don't know, free fall might be too big of a word, but that's definitely on the table, because we never saw the bottom in 2008. And we know that the only reason that the market is where it is now is because QE won in March 2009. So I think the Fed has to do QE3 in order to maintain the price stability that we have now and maintain the illusion of recovery.
Those are very good points, Aaron. And might I also add, too, that the S&P 500 last year was really only up about 13%, and the Austrian school TMS inflation rate was 11%. So you can account,
Yeah.
for the little difference gap there being, speculators and momentum traders, trend followers, if you will, just speculating and driving the price up just a little bit beyond the inflation rate. But,
Yeah.
the Fed's in a box here. Fed's in a box here because, if the market does crash, the U.S. has a humongous amount of baby boomers, and, they're holding a lot of them are holding, stock portfolios that still haven't, recovered really. A lot of them haven't recovered that much, since the crash. Some of their stocks might have recovered, but, some of the stuff maybe hasn't. You have Bill Gross leaving, Treasuries, leaving
hmm
PIMCO. So this is just like a barrage of news here. And it's what do you think are the safe plays here going forward? Do you mentioned to me off the interview before we started here that there was double top in some of the indexes that you were looking at. Where do you think there's safety in this environment? Inflation or deflation? The Fed just extends QE2 or doesn't or whatever. We obviously think the Fed's going to extend QE2. I think that the Fed hit it in QE2 when they got QE2 approved. that there was an extension hidden in there that they could continue QE2 indefinitely. So they don't even have to, announce a QE3, and they could continue to buy $800 billion worth of treasuries every year now indefinitely.
Right. And, another thing that's very interesting is how the market is reacting um, to the current, uh, the news that's coming out and the Fed's actions. And if you look at what's going on in Portugal, they need a bailout in order for their government to function. If this was going on a year ago, which essentially it was with Greece, like almost literally exactly 1 year ago, uh, the market was, about to fall apart. It was, in shambles after QE1 ended, and the Greece debt crisis was a catalyst for that. But now, what are we seeing? The market just rallied for the last 3 weeks, and it has, on the SPY, the S&P Spider, it has kind of hit a double top at about 132.50, but it still rallied, and we're seeing a light volume rally, and that's fueled by POMO. Whenever you have the light volume intraday in the markets, it's always POMO pushing it higher. Whenever you have the high volume, it's usually selling volume, which trumps the about 1 billion in POMO. But getting back to what I was saying before, though, the market expects there to be intervention, and that's what I think is going on with this Portugal situation. Is fundamentally the market should be selling and the dollar should be rallying right now, but the market is pricing in the intervention that they know is going to happen. They know that whatever happens, Bernanke will come up with some way to create a massive liquidity that just devalues the dollar, and nobody wants to hold the dollar right now. And I know I've said before that the dollar would be a good play going forward, and I'm going to stick by that because I still believe that I have the fundamentals right in the ultimate long run. I think that other currencies will eventually fail before the dollar. I, I mean, I think the dollar can go lower for a long time, but I think ultimately it will be the last one standing, so to say. And I'm not going to abandon that position. A lot of Austrian economists who called the housing bubble back in 2004, 2005 stood by their position. I'm going to stand by mine, but it is worth noting that we are just pumping the global markets full of dollars, and nobody wants to hold them right now. And the market has just gotten used to the intervention, and they are pricing it in, even though there's, legitimate deflation risk like right in front of us.
Well, those are some very good points, Aaron. I don't necessarily agree with you about the dollar. I think other countries will, out of necessity to keep themselves in power, I think they will depeg. Because I think, China's trying price controls now. China has, almost out of control inflation now. Depending upon what estimates you talk to, inflation is 20% or higher there. India has super high inflation. I just saw earlier in the week that, South Korea has bad inflation. And, Walmart, the Walmart CEO just came out earlier today, and he was talking about how inflation over there in China in their factories and stuff. The Chinese can't absorb the inflation that it's the American consumer is going to have to deal with it. So this is going to be something that the markets are going to have to address. That's going to affect everyone worldwide. And the question is going to be, it's a political problem because of the intervention, like you said. This is a central banking and political problem now. This is what happens, when central planners and interventionists go into markets here.
Absolutely.
Yeah. And, the question is now, what are the unintended consequences going to be? Because, what the free markets want. The free markets want deflation. The free markets, they want to let the credits wipe themselves out, and deal with the debt problem. And the Fed doesn't want that. So, and the other central bankers in the Western world really don't want that either. So you have the Fed here in a paper fiat money system. You have the unstoppable force against, what is it, the immovable object.
Mm.
So this is I honestly, I see some of the deflationary pressures here. At least in private sector credit. where small businesses can't get loans, and people's credit, the amount of credit they can have on their credit card, that's declining. So you are seeing some deflationary stuff here, but like, will they let it? Will they allow it?
Right.
That's
Well,
one of the questions. Yeah.
that's the beauty of central banking is because you can have deflationary pressures, but if they decide to, they can just expand the money supply anytime they want. And it seems more and more like Bernanke's unintended consequences are the unstated goal. And the unstated goal is to just run the emerging markets into the ground because they're sitting on the dollar peg and they're stealing the liquidity that Bernanke wants to be here. And he said more than once that he wants the Chinese to remove the dollar peg, which he's insane for saying that, but um, at least from his point of view, because I don't see how he could want 20% inflation here, but I
Well,
think
I,
he,
I think they don't care, because I think they'll think it's, a short-term problem, and they'll think that it's going to bring jobs back, Aaron. I
yeah,
think that's why they think that it'll be okay, because, okay, our people will have, 15, 20% inflation for, 2 or 3 years, but then we'll get the jobs back. And I think that's what they are planning, but I don't think things are going to work out that way because, there's other factors involved, like, oil prices and stuff like that. So, because we have a global economy and goods are moving back and forth at different parts of the value chain. So
exactly.
yeah, so this is a very interesting thing, and even still, we don't produce our own food here. A lot of our grocery store food, like fruits and vegetables, for people to have fruits and all the different types of fruits and vegetables, they're flown in year round. So when something's out of season here in the U.S., it's flown in from South America or Asia or wherever. So this is a very interesting problem. It will be very interesting to see how things play out. Um, Before we finish everything off, I've kept you on here for a long time here, Aaron. I definitely want to get, your full thoughts here on where do you think safety is, and I want to talk to you, about gold and silver. So I personally think that gold and silver are by far still the safe plays. Probably, gold, with the deflation risk you mentioned, gold is probably a little bit of a safer thing, because of less volatility. Probably gold would outperform silver probably in a deflationary type of 2008 scenario if we did have one. I think the real price of gold might even go up in terms of purchasing power, and the gold miners, would make a lot of money as oil would probably drop in that scenario too. So I was wondering your opinions, Aaron, on the gold to silver ratio. What you think's the gold silver ratio, how that's gonna perform for the rest of the year, and if you think maybe gold would outperform silver for the next few months.
Well, I think that gold's definitely going to well, maybe not outperform, but at least catch up to silver in the next couple of months, and that's just based on the amount of consolidation that's taken place in gold since about October. I mean, it really hasn't moved that far, and it's been a really choppy, choppy trading pattern. If you're a trader, a swing trader, you probably love it right now because it's been up and down. But I think the gold and silver ratio, I think that silver will gain on gold for as long as we have this inflating and borrowing policy, because ultimately silver and other commodities are more useful in everyday life than gold. And when you have the POMO just coming in and buying up all these assets intraday, it's just going to drive silver up. It's going to force the institutions and the managed money to buy silver just to uh, meet their expectations. But I think that gold should catch up, and it should continue on to the next leg in the bull market very soon. It's consolidated for quite a long time, and I'm not just looking at the daily, 6-month chart, but looking at the 2 or 3 yearly chart, or the weekly chart, 2 or 3 year chart, excuse me. Uh, it's not very extended from the 20 and the 26 moving averages. It's kept a very strong trend line in place. I think that as low as it can come down to is about 1400 or 1380 before the next breakout, but I would be very surprised to see it consolidate for more than a couple more months. And I think that the ratio will, um, at least stay the same or come down a little bit in gold's favor for the next couple of months. But if the Fed does anything uh, public, like announces a QE3 or publicly announces an extension of QE2 or something to that nature, the ratio will continue to um, move into silver's favor because it's more applicable to you know everyday life in the global economy.
I also think, Aaron, that silver will be favored in that scenario that you said, in a melt-up mode, crack up boom type of scenario, because, like Eric Sprott has said in his great research, that $1 of silver is now $1 is going in to physical silver for every $1 that goes into gold, and that hadn't happened before. So, and the silver market is just so small that there's no way the ratio can sustain itself at these levels, that the price just has to go higher if that's going to continue. So that's like a fundamental reason, as people are going to say that, well, I have, $1,500, I don't want to buy 1 ounce of gold. I don't want to buy one gold coin, even with a premium. I don't know if you could buy a gold coin with the premium on that for 1,500, but, I could buy a decent amount of silver. And, people are continuing.
Absolutely.
Yeah, that's like just, a common sense thing that, like, well, I'll own X amount of ounces of silver instead of just one gold coin. So I think that's some
Right.
fundamental thing that's driving. Another thing that's fundamental that's driving, that I'm seeing, that I'm reading about, is the Gold Report mentioned this in multiple articles like this week, was that, just a ton of money, a ton of, institutional money, hedge fund money, and even, smart billionaire money, people that are worth 150 million or more, that people are writing checks now to these silver juniors, that people are funding, small little silver junior companies. There's literally hundreds of millions of dollars now behind the scenes, that unless you're paying attention to the market every day and reading all the little stories, and I'm not reading all of them, but I'm reading my share, and you're just seeing a flow of funds. So that's going to, force the market higher.
Yeah, and there's some people that I've talked to recently that have been doubting the supply shortage that's been going on in silver, and one of the points that they were making is that the 100-ounce bars isn't really that big of a deal. I think I talked to somebody who had quite a bit of experience in dealing bullion, and he said that the Perth Mint running out of 100-ounce bars wasn't a big deal because they still had 1,000-ounce bars or something like that. But even if that story was 100% fake, it was just falsified, you still have the backwardation that's been going on for 3 months. And as we talked about before, backwardation only lasts typically a few minutes. It's usually something that starts off of a rumor, and it's just a flash in the pan scenario. But we have backwardation. Now that is proof that people are taking delivery and the physical market is drying up. The physical silver market, it's a fact that it is drying up. And, these junior producers, even the ones with bad valuations and the high costs, they still could become 2 and 3 baggers at the very least. It's really incredible what you can do when you have a central banking system that just loves to add liquidity to markets that really want to deflate.
Exactly, Aaron. And, the profit margins at $37 silver, and oil prices is high, base metals is high, and if they have a little bit of gold as a byproduct, to go with the silver, the profit margins are just robust for some of these silver mining companies. They're just going to, the next few quarters are just going to be fantastic.
Yeah, and a lot of people were surprised at the earnings of Silver Wheaton put out about a month or two ago for Q4, and that's just the beginning, really. Another company that you and I followed, Revit Minerals, that's going to uplist on the Amex soon. 2 more companies that we followed recently uplisted, First Majestic and Great Panther.
Oh, yeah, both had big pops, yeah.
Yeah, it's we're really starting to feel it take off now.
Yeah, well, this is like, I read an article about Chen Lin talking about this, how, in a bull market like this, in a secular long-term bull market, how, the smaller junior stocks, they become, they were originally liquid, and then, a year later, like Great Panther and First Majestic, they're super liquid now. So this is just, beautiful. And, Chen Lin's strategy is to, rotate out of, like, Great Panther and First Majestic after they uplist, and stock goes up, and then rotate back into the more liquid juniors, and just the process is going to repeat itself basically.
Exactly. I remember when First Majestic had, it was lucky to get 400,000 volume for the day, and now it's getting well over a million a day. And you can just go, like you just said, right back to the companies that are getting, just five figures in volume a day, and look up their valuations, see what they have for resources, and it's almost it's like easy picking right there.
Well, we need to send a thank you card to Ben Bernanke. Like, I guess this is the good part about inflation. We're starting to see the bad parts at the grocery store and the restaurant and stuff. Like, I'm definitely noticing, prices are higher, portions are smaller, and gas prices are expensive. But we're also experiencing some of the good parts of inflation. The asset price inflation.
All right, and that comes through education.
Exactly. To close up here, Aaron, you already talked about gold and silver, what your expected predictions are maybe for the rest of the year. Do you have any companies that you've been following, gold, silver, where you think there's still value? Like, I personally think there's a lot of value, in the gold mining stocks. Like, for people who are more patient, because, they just lag so badly, a lot of them. Like, really only New Gold has performed even reasonably well in terms of the regular gold miners. A lot of these gold producers have done, horribly, just absolutely horribly. They've,
Yeah.
way underperformed here. They've lost the silver stocks have done really well. Some of them are fairly valued now. I think it's a lot harder now to find value in the silver stocks. Although those are going to be doing well still. It's just not grossly undervalued like they were a year or a year and a half ago.
Right. I have a couple of valuation plays. One of them, our friend Chris Marchese talked about a lot, was Aetna, and they have just lagged very immensely. They're back down to about 58 or 59 cents a share, and market cap to resource value based on industry average is well over $1 a share. Um, and operating cash flow multiple, is about 1.5, but that's at gold with 1,400 an ounce. If it goes to 15 or 1,600, I mean, they're worth a lot more than that. Another one I've been looking at is a speculative play. I've talked to you about it a couple times. There's Abacus Mining. They have the potential to produce about 100,000 ounces of gold a year, and they produce copper as well, but just using them as a gold valuation with a mine life of 23 years, their valuation based on industry average is about $1.07 a share. They're trading at about 20 cents a share right now, and they're currently doing a feasibility study, which I'm keeping in close contact with any news coming out of that, because even if they can get their hands on a portion of the resources that they have, they would be just an absolute valuation play right off the bat.
Okay, and to add for people to do further research on, I like Brigus Gold, symbol BRD. I think that's a very good valuation play. They've just finished construction of the underground mining stuff at Black Fox there. So they've already been producing, on the open pit, like about 65,000 ounces of gold this year. I think they're going to do, and next year they're going to do the production guidance, hopefully, that they originally guided. So next year will be really good, I think, for Brigus Gold. I would be patient with them, and I would maybe look at starting to accumulate a position if people haven't done so in Brigus Gold. I think at worst, Brigus will probably be a takeover candidate. They have really, good gold grades. And another one is Crocodile Gold, CRK on the TSX. That stock, has benefited, not benefited, not unless I'm joking about it, but they've, experienced some really bad flooding there in Australia with the torrential downpours with the rain, and some of their gold mines got flooded. They have 4 gold mines in production. The fact that the mine wasn't, producing up to the stated goal has made them, go back to the market for a little bit more debt and raise some more equity. They're going to be fine though in 2 or 3 years. they already have the mines in production. That's like the hardest part, Aaron. So I think people are close to, Crocodile Gold. They can, it's a good spec play stock if people do the research and are comfortable with the financials. It's right around a 52-week low, and some other really good newsletter writers who I respect, like James West of the Midas Letter, went and bought shares recently.
Yeah, like we were just saying, a lot of these gold stocks are near a 52-week low, like Brigus and Aetna. Uh, they've really underperformed spot price, and people have really kind of forgotten about gold, and they've gone into, like we said before, silver and the base metals because they're consumable. The physical market is drying up, but I think that gold is way overdue for a rebound. And if you've done the research on some junior plays, you can absolutely make money here from a valuation standpoint and just from a technical standpoint, just from lagging the sector, really.
And people are gonna, to tell people are gonna have to, be patient about with the gold stocks because, it's probably gonna take a couple quarters of, better earnings for the stocks to, start moving. So this is something that, probably in the next year that we'll be talking about. Oh, well, remember when we were telling people about, buying back then and, starting positions and, just accumulating. It's just, patience is some people, investors, we as human beings, some people have trouble, with patience and, it just goes against our mass psychology. So, it's as an investor, if you're a trader, okay, then maybe you can't be patient if you're a momentum guy, but if you're an investor, patience is something people are going to have to learn. To finish up here, Aaron, what are some resistance levels for gold here that people should look out for on the charts there that will, give them the markers there that gold's, making its big move, above 1500, going towards 1600. There's some people that are even calling for 1800 or 2000 gold this year. Now, I don't know if we'll get there. I think we got a shot at 1600 though.
I think 1700 would be 17 or 1800 could be like a top. I don't know if it would be like a confirmed top or anything like that, but just an intraday or an intra-week top. But right now, as of today, I'm looking at the GLD right now, and it's at 139.86, and that's a triple top going back to the beginning of March. And there's a couple of indicators that you want to look at for gold and silver, and I always use the ETFs, SLV and GLD, and the volume is by far my best friend when it comes to determining a breakout point. Now, like I said, we're looking at a triple top in gold here at 139 or 140 on the GLD and about 1430 for spot price. So I think that could retrace because it is a triple top. It may come down to about 1400, 1380 at the very lowest. But if it does that, I don't think there's anything standing in the way of it just pretty much just blasting through a 1440 and then going on to 1500 an ounce. For silver right now, we've kind of meandered a little bit off of the lows at 34 an ounce, and we're pushing up 38. We are a little bit extended from a few moving averages, but as a lot of traders learned, not to bet against silver when there's 0% interest rates and QE2 going on. I don't think moving averages, the price being overextended for moving averages means a whole lot, but you do have to watch out because silver can get overextended and it can come down hard like it did in January. But if you're watching the volume on the ETFs and you're watching the candlesticks and just letting the market tell you what's going on, you can also trade that on top of owning long-term positions in producing miners.
Yeah, those are some good points, Aaron. Based on what I'm hearing too, the smart money's ready to come in and buy every dip on silver. So I think I don't expect humongous pullback for silver yet. Maybe if we break through 40 and head to 50, and a lot of my friends start asking me, oh, can I buy some silver? Then we might have like, $10 or $15 pullback then, but I just don't see it right now. Like I see strength on the chart. I see strength, in the price. I watch the ticker sometimes, and a little bit of a drop, and it's it recovers so quickly. Whereas even a year and a half, 2 years ago, it would have taken a month or two, even more sometimes, for it to recover in prices quickly, and it's doing it sometimes even in a couple hours. Um, Back to your triple top here, Aaron, on the gold chart. Like, I'm not a technician here, but I do know some stuff about technicals, and more recently than the triple top, what I see, developing in the GLD chart here is I see the cup here more recently, and it looks like we have a handle forming here. Do we have a cup with a handle? Because it looks like the volume has started to dissipate too. And if I remember correctly about the patented cup with a handle chart formation, and normally the cup with the handles are pretty reliable, as the Investor's Business Daily guy, basically like he made his whole fortune off of just buying cup with handles on charts. So what is your opinion here of the cup with the handle formation on the GLD and gold chart?
Well, I think that you could have an argument there for a cup and handle. There's been multiple cup and handle breakouts in gold since the financial collapse and since gold recovered after the bailouts in QE2. If you use the weekly chart, you can see multiple cup and handle breakouts. It's very, very bullish chart. And I think the short-term triple top I've been talking about has been over, the last month or so, but we never really fully broke out after the February or late January lows. I mean, we made new highs, but we didn't break out and begin the next leg in the bull market. So I think that we could come down and retrace and still, I think it still could be a cup and handle, even if we retrace a little bit here. I don't think that gold has quite enough momentum to make new highs right now, based on just what I'm seeing with the charts. There's a lot of gaps. Trading gaps indicate weakness. It indicates that the sellers are not selling at these levels yet. They're waiting for it to go higher and hit a resistance point before they want to sell. But I think that like I said, we will have a little bit of a pullback closer to the 20 or the 26 moving average on the weekly chart, and then we could complete a cup and handle breakout. And a cup and handle isn't confirmed until there's a breakout above a major resistance point with volume backing. But I think you do have, you're definitely onto something though, that it does look like there is some type of cup and handle formation going back to the beginning of the year, down to the dip, and then to where we are now.
Okay, so it looks like this would be time then for maybe people to add a little bit to their gold position, or buy part of a position if they were planning on starting a position then, and maybe wait for the breakout to be confirmed if they're a trader.
Yeah, absolutely.
Okay, well, thank you very much, Aaron. And can you please tell our listeners here where they can find your work?
I post all the time at aaronbasile.wordpress.com.